can hear me, right? Hello? All right. The network, the internet, is it stable? Okay. That means you can hear me loud and clear, right? Okay. So we are at the fifth session today, right? Hello? Oh, I'm having a very terrible internet. My internet seems so terrible today because I'm lagging. Whatever I said, it takes you time to hear me. Give me a second. Hello? Hello? Can you hear me? Okay, I'm trying to update this internet. Hello? Can you hear me now? All right, thank you. So we are at the fifth session today, and the fifth session is all about market intention. And when I say market intention, it has to do with the things you see in price that gives you an intent, that tells you what price has an intention to do. Like if you see things like this, it tells you this is likely what price is gonna do. And these are things I came up together to find myself. Like this were like the confluence I I found myself. All right. There were things I developed through chart study and I was able to like come up with it. So when you go to the chart, these are like the things that is going to give you an extra confluence to your trading. All right. And the first one we're going to talk about is MSCPOI and mitigation of inducement. Okay. And MSCPOI is a point of interest gotten from a complete MSU. Okay. An MSU POI is a POI gotten from a complete MSU. So if you have a fake break of structure, you have an inducement, you have a true break of structure. All right. If this is a higher time frame, because we have a higher time frame and we have a lower time frame. On the higher time frame, you can't use the whole range as your MSU POI. Okay, which means you can't do this. Okay, ideally, this is the objective way to draw the point of entry, but it's not going to give you a precise entry. All right. So what you need is the last candle before the inefficiency. That's the refined POI. But if yes, yes, yes. But if you are picking a point of interest on the lower time frame, 5 minutes and 1 minute, you can pick the whole range. You can pick the whole range as what? Yes, yes, it goes on the slide exactly. So on the higher time frame, it has to be refined. On lower time frame, you can use the whole range. All right. On the lower time frame, also, if you want to have a precise entry, you could also still define it. Okay, you could also still define it to give you a proper entry. All right. So that is what's okay. All right. So this is the MSG POI on the higher time frame, and this right here is the MSG POI on the lower time frame. Now, to validate an MSG POI, okay, it has to do with what we did about criteria to validate a zone. Okay, but in this case, an MSG POI, if it follows order flow, okay, if it follows an order flow, which means it follows the trend, it makes it more valid to trade. Sorry? Yes, yes, yes. It has to follow the trend. You need to have something like this to follow the trend, right? Something like it should follow the trend. So it gives you the confidence that price is coming forwards, a mitigation before a continuation. All right. So the first criteria is that it should follow the trend. Okay. The second criteria is that if you don't have an inefficiency below it, okay, you don't have an inefficiency below it, there's a possibility that price can respect it and give a buy continuation. But when we're talking about a high probability MSU POI, if it has something like this, this is a high probability MSU POI because you have what? A complete efficiency. Okay, you have an efficiency below it, so it makes it more valid. All right. So another one is when you have a liquidity before the mitigation. Okay, if you have a liquidity before the mitigation, this could be an inducement liquidity or it could be a structural liquidity. As long as you have a liquidity like this, it doesn't matter. Okay, you could have this, okay, as a structural liquidity. So price comes back to, do this. All right. Okay, so these are the criteria to validate your MHPO. Now, the second one, which they're like sibling, is the mitigation of inducement. Okay, mitigation of inducement. Mitigation of inducement is when you have price coming back to the high or low that gives inducement before the true break of structure. All right. If you have this as MSU POI, okay, mitigation of inducement gives you what? Fake break of structure, inducement, and mitigation before the true break of structure. Okay. Whenever you have something like this, the mitigation of inducement, it tells you that what? Price is building liquidity. That means this MSU POI is not a valid one because it has a build up below it. All right. It has a build up below it. So now what you have here is what? A mitigation of what? The low that took out the inducement level. Okay. Yes. Price can react to this. Okay. Only if the inducement mitigation has what? A liquidity that's taking liquidity like this. If you have this, okay, it is possible price respect this. Okay, price could respect this because this is what an MSCPY. Okay, but what you have here is a low probability point of interest because it has a build below. This one is high probability because it didn't have a mitigation of inducement before the true break of structure. But this gives you the mitigation of inducement before the true break of structure. Price will come back to mitigate the low that takes out liquidity. All right. Price comes back to mitigate the low that took out liquidity before you have your true breakout structure. So this is mitigation of inducement. Of inducement, and what you have here is MSU POI. Okay. So what is the importance of this mitigation of inducement? There are some cases whereby price will take a low. Okay. That what you need to do is well, price to come back to mitigate the low that takes out the liquidity before the true break of structure. Okay. Yes, price to come back. If you miss the bottom, you have to wait for what? The mitigation of this low. Okay, before what? Before the true break of structure. Let me show you an example. Okay, let's assume we have this as what? A fake break of structure, right? You have this as inducement. Okay, so the mitigation of this low before the true break of structure is what? Mitigation of inducement. That means whenever price is returning back, this low price has taken every money you have right here. So it means there's no mitigation that is going to happen. Price is more likely to what? Break through this low. Okay. Into your what? Your true break of structure below. Okay. So this right here is a mitigation of inducement. Another example is this: you have a fake break of structure, you have an inducement. Okay. So the mitigation, when price gives a retracement, this is it. So like I said, it is not a high probability POI. Price is going to burst through when it is coming back, unless you have the whole range. If this is an impulsive move to the upside, without giving a mitigation, price could expect it. And that is creating an MSU POI following order flow. But in this case, it is not following an order flow. But yeah, another example is of a mitigation of inducement. It's practically everywhere and it happens all the time. You have fake break, all right, inducement, and this is your mitigation before your what? Your true breakout structure. All right. So this is a mitigation of inducement. Let's see MSCPY. If you are trading within a range, okay, the only thing you're looking out for is what? An MSCPY. That is the only thing you're looking out for within a range. Anything from that, you don't have a business to do it. Okay. This is an let me see if I can get an example of MSCPY. You get to see it everywhere. Make sure it follows trend. All right. This is an example. You have a fake break of structure. Okay, you have an inducement. You have a true break of structure. So this whole level is your MSCPR. Okay. Like I said, can you see how it follows trend, right? So you need to make sure you're trading an MSCPY that follows the trend. Okay. Make sure it is following the trend. Another example is this: a fake break of structure, you have an inducement, and the price does what? Give a proper mitigation. Proper mitigation right here. So this is an MSCPY also. So within a range, the only thing you are looking for within a range is an MSCPY or this last structural liquidity. All right. Do you have a question? All right. Okay. Okay. So we have another MSCPY right here that gives you a fake an inducement. Okay. It has a liquidity, a structure. Exactly. A structural liquidity. So this is a perfect one. Every time frame, any time frame is valid on any time frame. It is valid on any time frame. Okay. when price is returning back to that level. Okay, it is a solid one when before you have a true break of structure. You can trade the mitigation to the true break of structure. But when price, yes, when price is returning back, it is not safe. Okay. Yes, you're right. Okay. Let me see if I see another example. Okay, another example is this. Okay. Even though price has already mitigated, price still came back to the mitigated without breaking it. Okay. And MSCPI is so strong that you can use a limit order for it. Are you are you with me? It is so strong that you can use a limit order for it. All right. So let's move to the next one. The next one we have is a failure swing. Do you know what the failure swing means? Yes. Whenever you have a swing point that price refuses to break, let's say price creates two swing points and price is within a range like this. Okay, you have price trapped in a range. Okay, within the range, you have this as your words, your buy money. And when I say buy money, it simply is people who are trying to buy to the upside. That means liquidity, right? And at the downside, you have what? Your sell money. Okay. The moment price goes to the buy money and fails to break it, okay, what you have here, this whole range becomes what? A liquidity. Okay. This whole range becomes a liquidity until the sell money. That means you can't take a buy within this. This whole level, price is going to break through all this level. If you are buying, it has to be this you are buying from or a liquidity on the left. We'll talk about that. It has to be a liquidity on the left. All right. So the buy money becomes the failure swing. This is the failure swing. Okay. So you can't take a buy from this. No, you can't take a buy. The only time you can take a buy within this is if you have, that means this failure swing is not going to be successful. If you have this low coming from what? A higher time frame inducement level, like this. Okay. So there's a high chance price comes back to take the last structural liquidity right here, then a buy continuation. Do you see how it's so beautiful to build a logic around price? Yes, yes, yes. So the sell money now becomes the main failure swing because we've taken a liquidity on the left. So this is what a failure swing is all about. So in a case whereby this low is not coming from a liquidity level, right? This low is not coming from a liquidity level. That means you have something like this. All right. Now let me show you something. You have something like this. Okay. That means price has created a build up. Okay. This is a very, very good way to build logic around price. Price has built a build up right here. Then you have like a structural liquidity close to this. Okay. To validate a failure swing, most time you're going to have a structural liquidity that price will take. So it is going to what? Drop down to all this. That means you have to find what? A sell continuation within this range, especially when you have this whole range with a build up, no MS. If you don't have MSPI within this range, that means you just keep back selling, keep selling, keep selling until the sell money. Are you with me? So this is what it is. Let me show you a failure swing, a typical example. Like it's every year on the chart, and I'm going to show you many examples. The sell-off that happened on last, okay, we have this structural liquidity, right? So the last low created before price came for this high is this low. We have this as what? Our buy money, and this as what? Our sell money. Okay? Is our sell money, and this right here is our buy money. Okay? You have your structural liquidity here. Okay? So if price cannot take this buy money, it is to tell you that what? You are coming for this sell money. Exactly the same thing that happened right here also. You have this right here, the buy money, and this is what? The sell money. If price cannot take this, okay, automatically you're coming forward this low. That means this low is a weak low because there is no liquidity that it has been taken. And building the logic around price, you already know that this low is the target because price fails to break this high, which means you are coming for this low. That's to tell you that what price created this low, fails to break this high, automatically what we are coming for this low. Do you see how beautiful it is to relate with price? Another example is this. Price didn't take this low, right? Just formed equal low. Okay. There's no reason for you to sell within this range because automatically this high is not coming from a liquidity level. Assuming it's from a liquidity level, that means what? You can step up. This failure swing is going to drive price up towards the buy money. This is the beauty of it. Okay. So this becomes, like I said, if you have a structural liquidity close to the extreme of your swing point, it makes the failure swing more valid. Do you understand? Let's say another example. Yes, another example is this. Imagine you are buying from this low. Did you take this buy on this day? Imagine you are buying from this low because I saw you were buying. All right. And actually, I was expecting price to take out this high for me to sell to the downside because what we have this high giving us a TLQ from this high. Right? Now, imagine buying from this low and expecting price to take out this high, which obviously I'll be expecting to. And we went into Asia, okay, price start giving retracement. If I'm to take a trade, I'm going to target inefficiency because we have this whole level in an efficient level. This whole level is already efficient. Okay? This whole level is already efficient, and we have this low, this right here, inefficient. Okay? If I wake up and I see a failure swing right here, okay? You see a failure swing right here. Pay attention, please. All right? Imagine seeing this and price start giving a retracement. What are you going to do? The only thing you can do is wait for what? Price to take a liquidity within this range for you to find a continuation. And this low right here is not coming from a valid liquidity level. This is the only liquidity level you took. Okay. And we still have what? We still have inefficiency below. Yes, 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 yes. I like how you're paying attention. It's not something important. So it is not come from liquidity level. We have efficiency right here, and there's nothing to hold price within this range for price to keep buying to the upside. So you see how it is to build logic around price. Just do this, then you find your sell continuation. Yes, ILQ inducement liquidity because you have a fake break of structure, inducement, then a continuation. Okay. Do you have a question? Yes, yes, yes. Now, let me show you what I told you about. Let's say you have this, okay? You have this as what? Mitigation of inducement because this high is coming from what? And I'm sure we have a liquidity on the left that we must have taken. Okay, no liquidity on the left. So you have this, right? You have this because price gave you a mitigation of inducement. Okay, mitigation of inducement. And this is your fake break, right? And this is your true break. Okay. Like I said, price could also respect this because what? Unless, yes, it took out this liquidity right here. Remember I told you it took this liquidity right here. So yes, it could take this. Now, price came forward this low. If we can't take the buy money, this is the buy money. Like I said, we come forward, the sell money. The moment you come for the sell money, whatever you have above becomes a liquidity target. If you have a failure swing that is successful, okay, but it's successful, like I said, your liquidity on the left for precision. Remember what I told you? Liquidity on the left for precision. This, okay. The moment you have what a successful failure swing, and price is giving a reversal to the upside, it is going to violate everything you have right here. And that's exactly what happened here. Okay. Do you have a question or see more examples? It's all right. So the next one we have is what? AMD. I'm sure you know an AMD. An AMD from the name is an accumulation, a manipulation, and distribution. That means price is going to give you a range first. Price will give you a range. It will manipulate people into the wrong direction. Okay. Manipulation and the distribution is that what? The actual direction. So you get to see price doing something like this. Okay. To the downside, right? Then it gives you this. Because most time you must have what? A higher time frame build up level and maybe efficiency. See how beautiful it is to relate it price. Logic around price. So this is your accumulation, this is your manipulation, And that is your distribution. Okay. Fun fact is you are going to experience this all the time. Let me not say all the time, but it is practically everywhere in the market. Okay. So whenever I see a range happening, what you are going to do is what? You wait for price to break outside the range first. Okay. You have a range right here. Okay. Price broke out, like I told you, to take out what? A liquidity on the left. Before what? The distribution to the downside. The distribution is going to be times two, at least times two of the manipulation. So whenever I see a range happening and price breaks outside the range to the opposite side, that is to tell you that you should anticipate what? An AMD to happen. An AMD to happen. An example is this. Price gave you this, all right, to the downside to take what? A liquidity. Remember to take a liquidity. And yes, the distribution to the upside. Okay. Like I said, the distribution is the main move because it's going to be like times two of the manipulation. And the reason why it is called manipulation is that remember, if the sell start happening, okay, it is going to give people the mentality that price wants to what? Price wants to give a buy. Sorry, if this sell is happening, okay, it is going to give people the mentality that what? Price is selling. It's going to sell. So they start looking for a sell continuation. Meanwhile, the actual move is the buy. A very fake sentiment. Perfect. An example is this again. You have a range happening. Price break to the upside to take something. What did it take? What did we have? Let's say previous monthly high, right? Yes, I took this sell also. I took it. We all, yes, I took this sell. So there's always going to be like a liquidity on the left that price must have taken. Okay. So whenever I see a range happening in your mind, anticipate what? An AMD. Okay. Anticipates an AMD. All right. An example is this also. You can see it's going to be like a range breakouts to take what? A liquidity, then the yes, yes. Okay. This high, right? You should be able to annotate. Okay. Which law is that? this distribution, right? This, are you talking about the same liquid is less, yes. Okay. Yes. It's it's mitigated on MSCPI. Yes, on MSCPI, I say on a lower time frame, the price mitigated. Yes. So yes, that is an AMD. And do you have a question, or should you look more examples? Always pay attention to price whenever you are having a range happening. Okay. All right. You have a question. Okay. So since you don't have a question, we can move forward to the next. So the next one we are going for is accumulation and distribution liquidity. It is similar to AMD, but quite different. So accumulation and distribution liquidity is whenever I see a distribution happening or you see an accumulation happening, all right, any kind of point of interest you have below a range, okay, any point of interest you have below a distribution like this, it is not going to hold. Or if it is an accumulation like this. Okay. Any point of interest you have above is not going to hold. All right. Yes, yes, yes. The point of interest you have opposite is not going to hold. Sorry? They're the same. If Asia is giving you a range, it's they are that an accumulation. Whenever you see a range, it doesn't matter if it's Asia or London. Yeah, yes. Okay. So any point of interest above or below becomes what? A target. I'm going to show you multiple examples. So if you see a range happening and price start driving, all right, you don't trade a mitigation above or below. You wait for liquidity to get taken. Okay. This is an example. A typical example that happened on Friday. This is a range happening. You don't trade this POI. It becomes what? A trap. Okay. If you see a range happening, all right, you don't trade this POI. Yes, yes, because there was a reason why they did that accumulation for price to be able to what? Push further. For price to be able to push further. Another example is this. Okay. So you don't trade this. Another example is this. You don't trade any mitigation above it. It's not going to hold. That's your wife? Oh, your sister. It's all right. No, no, no. It's okay. It's okay, brother. So yes, this is what the ADL is all about. Whenever the things I'm teaching you today, if you add it to your trading, it gives you a precise, solid entry. It gives you a solid direction. Imagine going to the chart and seeing this kind of range. It tells you that what if you see a range like this, any kind of point of interest opposite, it's not going to hold. Okay, this is not going to hold. You wait for it to get taken, then you buy. Okay, you should be able to annotate this. Yes, yes, exactly. Because price took liquidity, right? Yes, it's not going to be respected because this is an accumulation, and obviously this is the manipulation to take this liquidity, then they sell. Okay. Another example is this. It's not going to hold. All right. So this is what the ADL is all about. You have any time frame, any time frame. All right. So let's talk about momentum and false momentum. So momentum in price signifies strength. Okay. Whenever you see a high volatile candle in price or in a push, that signifies momentum. And it's meant to what, give a continuation or an impulsive move to the actual direction. Okay. An example of a momentum is what you have here. Let me show you. Uh, this these candles are momentum. You can see momentum kicking into the upside. All right. You can see this candle, this heavy candle signifies momentum. Okay. You can see this candle's momentum. So a false momentum is a fake momentum, which means it is a type of momentum that is meant to take liquidity before a reversal. A false momentum will take out a high or low aggressively before giving a reversal. Like this. You can see how this buy happened to take out this high. Then we had a drop. Okay. So this is what a false momentum is all about. If you see a liquidity level that price take out the liquidity level with a false momentum or with a strong momentum, it is a confirmation that price is likely to give us a reversal. I like to see my liquidity level taken out aggressively. Yes, to be attacked aggressively. All right. Like this. This is a false momentum. You can see how price break this with a heavy candle, then keep before giving a reversal. Okay. So that is what a false momentum is all about. All right. Like something like this. You can see how this buy happened to the upside to take out this. Okay. So I like to see a momentum happening. I will know that that is a false momentum before the actual direction. All right. So we have transfer of money versus bid up. I think this is the main source. Now, transfer of money is the continuous mitigation or protection of a low or high into the next draw on liquidity. Transfer of money is a continuous protection or mitigation of lows or highs into a draw on liquidity. Yes, into a draw on liquidity. After taking a liquidity to the next liquidity. Transfer of money is the continuous protection of lows and highs after taking a liquidity to the next draw on liquidity. All right. So this is transfer of money. That means a continuous protection and mitigation of lows. This is a typical example of what a transfer of money. A liquidity taking into the next draw on liquidity. All right. What you have here is a transfer of money. Then build up, on the other hand, is when you have a complete transfer of money. Okay. Build up is the liquidity before. All right. Yes. So the moment you have this liquidity taken, transfer of money becomes what? A build up. Yes, 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 yes. Sorry? Okay. Sorry. Can you come again? Yes. The moment you have this, before this liquidity is taken, right? You can stack any kind of buy opportunity into this high. Buy opportunity, you can stack as many as you want into this high. Because price is going to protect this low until this high is taken. Then when you have this high taken, this term, yes, it becomes a build up. So it's the same thing. Let me show you like this. Okay. So what you have here is a build up because you have the next draw on liquidity taking. So transfer of money and build up are basically the same. One is before, one is after. So this right here is what? Build up. Yes, yes, yes. So this becomes what? Transfer of money. So it's like a cycle. When transfer of money is done, it becomes build up. When build up is done, it becomes transfer of money. So like that, like that. Sure, sure. I'm going to do that. All right. The moment you have this liquidity taking, okay, when this is taking, comma, form becomes build up. All right. Do you understand now? So we have three types of build up. Let's talk about them first. Yes. So we have three types of build up, and you need to pay attention to price so that you can see them. So the first one we have is the relatively, sorry, I'm coming. All right. So we have build up. Okay. Number one, we have trend line build up. That means you have what? At least three touches. Okay. You have one, two, three. This is a trend line build up. All right. A trend line build up. Second one we have is mitigation build up or EPA build up. You can see how everything is well explained and rules, you know. So after this call, I want you to write a review about the mentorship so far. So basically, mitigation or EPA build up is very, very simple and it's everywhere. But this is just two. All right, you have a mitigation right here. Okay. I mean, when price is returning back to this, price is not going to you can't buy from something like this because you have what and be a build up above. The only time you can buy from this, they are exceptional, is when what if price is closer to a liquidity level like this. If it is closer to a liquidity level, that means it's possible to what to do this to build to build more liquidity. But in this case, trust me, you can't buy from this. If price has taken the liquidity above, all right, this is going to be violated. Okay. So this is mitigation or EPA build-up. Yeah, it happened last week. Yes. Yes, 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 yes. All right. EPA is fine for continuation. You only trade EPA for continuation. That means price has not taken liquidity at the retracement side. Is it clear? I told you the fifth session is going to blow your mind. So basically, this is what's mitigation. Then the last type of build up is what? Relatively equal high or relatively equal low build up. Relatively equal high or low build up. Yes. So you have price, possibly, let's say you have this, because it is an MHPI, for example, so it tends to mitigate the last extreme by giving you equal lows like this. Okay? Equal lows like this, because it's possible. After taking liquidity above, remember, liquidity above is important. Then it comes forward. This. So what you have here is a relatively equal low because price is going to sorry, come again. It doesn't matter as long as it is a build up. Okay. So yep, let's see some crazy examples. The moment you have a liquidity taking at the opposite side, price, you have see a beautiful transfer of money right here. Until what? A liquidity has been taken. So when liquidity has been taken, right, it becomes what? A build-up. Another example is this. You can see this protection of lows, a complete mitigation to what? A liquidity to be taken. And don't, yeah, like a channel, yes. Don't forget, price cannot take this high because what? We have not taken liquidity below. So it is a form of transfer of money. So this low. Do you understand? Now, we've taken liquidity right here, right? Price will keep giving you what? Transfer of money, protecting the lows, transfer of money, protecting the lows until a liquidity above has been taken. Now, if you check within this range on the 1 minute time frame, let's do that. On the 1 minute time frame, you are going to see that you have a series of build up right here. This is a build up level, okay? Because this is a mitigation. It becomes what? A build up. So the only place you are looking for a buy opportunity is this. And if price can violate this, it is going to come forward the transfer of money you have here. Okay, this transfer of money now becomes a build-up when this liquidity has been taken. The same thing again, you're going to be seeing what? A transfer of money, price transferring money, protecting highs. Can you see? Protecting highs right here towards a liquidity level below. If you are seeing this, when price has taken liquidity on the left, it simply means what? Price is shifting order flow to the next draw on liquidity below. Same thing you have here. You keep seeing price protecting highs, protecting highs. Can you see? It means what? Price is shifting order flow, going to take a liquidity we have below. And then another example is this. You could see how price was protecting lows right here. See, see how it is well arranged until you have a liquidity taking above. Okay, a liquidity taken above. When it's been taken above, it becomes what? A build up, a transfer of money happening right here. You could see how price is protecting highs because you have inefficiency, which is a liquidity, and you have what? A higher time frame external liquidity right here. So whenever I see a build up happening, price will keep protecting lows, highs like this. Lows, high, can you see? Relatively equal low build up, mitigation build up right here. Okay, you could see how price is building like a channel to the upside. Okay, so when it is done, the same thing, you could see how perfect it is right here. See, so that's why whenever I take a sell from here, it is something I will do that I'm going to hold this. Now, if I'm holding my trade, it doesn't mean I'm buying below this. No, I'm not buying below this. Why? Because there have to be something on the left that I have to look out for. If you look at this angle, you could see that everything right here is a build up. Everything right here is a build up. That means there's nothing to hold price within this range. Okay, everything right. That means the whole low is going to be taken. Okay, the whole low is going to be taken. Can you see? Until the whole low was taken before price came for. Yes, like a cycle. Let me send you the screenshot. All right. Any question? No, no problem, no problem. So the next one we have is liquidity on the left and immediate liquidity. It is not very, very important. It's just to give you a precise direction, precise entry. So liquidity on the left is a liquidity created before, while an immediate liquidity is a liquidity freshly created. So if you are taking a buy right here, because automatically price gives you what? A fake break of structure, inducement, your liquidity on the left is really important because price will do what? Come for these before giving you a buy. All right, on the left, and this is your words. Okay. Okay. Sorry, can you come again with your question? All right, you will see a pencil icon. All right. Okay. No, I can't find. Okay. Yes, 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 yes. I can find it. Yes. Yes, yes, yes. Like I said, remember when I was explaining the failure swing? Okay, the low for the sell money is not as important as liquidity on the low. Let's say price gives you this. All right. If you are buying, it is not necessarily from this low. It has to be your liquidity on the left because this does not give you what? A fake break of structure. This has a fake, yes, this gives you a fake break, inducement, then to the upside. But this, if you are buying from this, is just a pure TLQ. Now, in this case, this could be what? A TLQ, okay? And this is ILQ. But ILQ is way stronger than TLQ. That is it. That is it here. Your liquidity on the left might be your ILQ, your immediate liquidity is your TLQ. All right. Do you understand? All right. Nice, nice, nice. So, brother, um, that is that for immediately. Let's see the example on each other. I think I give you an example on there was a loud buy, the FOMC buy, a precise entry for the buy. Yeah, this is an example. No, 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 not this. Yes, this is it. Okay. If the liquidity and you can perfect liquid, okay, assuming this swing low is an MSCPY, then price can just basically respect this and buy to the upside. Okay, for a precise entry, you go for your liquidity on the left than your immediate liquidity. If this right here is an MSCPY, price mitigated it here. Price mitigated it and gave a buy. If yes, it has to be like a structure point that price will take, then price will give a continuation. No, I don't have any problem. You just have the only thing in your mind is liquidity. No, no. And again, price gave you a confirmation to buy. Okay, price gave you a, you did give you price delivery. Yes, yes, yes. So price did this because of the inefficiency that is still below. So I will have gotten, but this was my entry. And nope, nope, nope. Liquidity is the main thing. All right. Momentum, yes. It dropped. It's gonna price dropped. uh, Yes. Yes. Okay. All right, brother. The next one we have is retracements, weak, and it's also something with swing point, weak and strong. So to know a retracement that is weak and strong, it has a criteria. Retracement is coming from a liquidity level, which means you should be careful looking for a continuation. If price gives you this and is giving you it to the downside, right? You need to be careful if it is not coming from a liquidity level on the left. Okay, if it is not coming from liquidity on the level on the left, it means what? If it is from a liquidity level, that means there's high chance price to this to push higher. Yes. All right. If this liquidity taken is a 1 minute liquidity and the overall low is coming from what? A higher time frame, like 1 hour or 4 hours liquidity. You should know that 1 hour is stronger than 1 minute, which means our price could see push higher. Okay. So a retracement coming from a liquidity level is a strong retracement. Okay. And a retracement coming from an inefficient level, an IPA, is a very, very weak retracement. A retracement coming from mitigation is also a weak retracement. Okay. Just like what we have here. We have this mitigation, right? You have this mitigation happen and you see a retracement. I'm going to look forward and EPA for me to what? To keep selling because it is not coming from what? A liquidity level. Now, if after this low is taken, I'll be very, very careful in looking forward a continuation because the liquidity has been taken. But then we still have a build up below that needs to be taken. All right. Whenever I see a push happening, not coming from a liquidity. Okay, let me give you this perfect example. You have this liquidity, right? Then you see this retracement happening. See this retracement mitigating what? This. You could see that this is a build up, right? And no liquidity has been taken. No, it is an equal high. Can you see? An equal high build up. Now, price mitigated an equal high build up and giving a retracement to the downside. This is to tell me that what? Exactly. Yes. That means I can find a continuation to take it. Now, this retracement that is happening is coming from what? A higher time frame high. That means this is a strong one. You can't look forwards. It's a buy continuation. Because it is a build up. Okay, there is a build up. All right. So you can't trade this mitigation. It is a low probability mitigation. All right. So yeah. All right. What do you mean? What do you mean? Okay. Now, if this is an MSCPI, this is what? It is a valid zone only if there's a liquidity that has been taken before the breakout structure. Okay. Same thing happened here. Look at it. It took out the liquidity, took out the liquidity, break structure, and has what? Series of equal high before it. So this is a valid zone. Okay. I think we took this sell on this day, me and this guy. So it's on a Friday. Was it on a Friday? On a Tuesday. Okay. Yes, it is a build up. Yeah. Price came back to mitigate this zone, this value zone. All right. Because it took out liquidity before breaking structure. Yes. An MSCPO, a valid one. Remember, price is trending to the downside. You can see. So the trend, it was is what matters. All right. So any question, brother? All right, brother. No question. Oh, this mitigation, right? Yes, yes. To a transfer money to a low below. Okay. Yes, you have a liquidity. Yes, yes. Yeah, you're paying attention. It's serious attention to block price. You know, the details matters. Yes. Yes, really sweet. Pay attention. Okay. So that is that about that. Any question? All right, brother. It's going to be next time, yeah? No, there's only a session for today, right? Yes, yes, yes. For what? Like seventh for question and for what? Yes, yes, it's possible. Why not? Yes, why not? All right, brother. That's after the sixth session, right? Surely, 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 we can do that. All right, bro. No problem. Yeah, I'll look to that. Okay. So, it's going to be next time. Yeah, let me send you the assignments. Yes, I already sent it. Okay, brother, I will do that. All right, all right. Thank you, man. So, have a wonderful weekend and take care of yourself. All right, man. Bye.